Chapter 5 here, receivables and revenue, with the focus being on receivables. So what are our learning objectives? We want to apply generally accepted accounting principles for proper revenue recognition, look at accounting for sales, returns, and allowances. How do we do journal entries and how do we account for sales discounts? How do we account for accounts receivable? Then one of the core topics in this chapter is evaluating the collectability of accounts receivable. So figuring out the allowance for uncollectible accounts. We'll also look at notes receivable and interest revenue. And finally, we'll do some analysis with some new ratios. So there'll be 3 new liquidity ratios. So let's apply GAAP for proper revenue recognition. To be clear, you could basically spend an entire semester class and have an entire career just around revenue recognition. That's how big of a deal this topic is in the field of accounting. Obviously, here we're just going to touch on it in this class and in a few slides. But again, I want to be clear that this is a very, very deep topic. But broadly speaking, revenue gets recognized when goods are delivered or services are performed. You're going to record it at the amount, so record it at the amount of the cash received or the fair market value of any assets that you received in the exchange. So somebody might pay you for your services by giving you a car, for example. Then you would just book the amount of your revenue at the fair market value of the car. We have, first of all, we have to understand what a contract is, and you'll go more into detail on this in business law class. But you can have a contract that is written or that is oral. This is an agreement between 2 parties, and it creates enforceable rights or performance obligations, okay? When you're doing revenue recognition, there's 5 steps that should be followed. Again, we don't go super deep in this, but just understand that this is a very broad and deep topic. You'll identify the contract, identify what the performance obligation is, figure out what the transaction price is, allocate the transaction price to the performance obligations, and then recognize revenue when those obligations are satisfied. Okay, so again, we keep things pretty simple in this class, but if you think about a construction company that is constructing a big project like a mall that will potentially take many years, how they recognize revenue around that construction project is a little bit more complex than we cover in this class. So for those of you who are interested in real estate, just keep that in mind. So let's look at an example here. Assume Apple Inc. delivers a truckload of iPhones to an AT&T wireless warehouse in Florida. On the truck are 30,000 iPhones, each of which Apple sells to AT&T for $100 on account. Each phone cost Apple $60 to produce. So Apple has to have 2 journal entries. One, they're going to have accounts receivable of $3 million, right? That is just the 30,000 iPhones times $100 per phone, and that's their sales revenue, $3 million. They also have to have a journal entry to get these iPhones out of their inventory. So they're going to debit this account cost of goods sold, right? An expense account. So we're increasing an expense account by debiting it. So each unit cost Apple $60 and they're selling 30,000 units. So that's how they get 1.8 million. And then that gets removed out of inventory as well. Right? And so this is recording the cost of products being sold. Some definitions here that we have to cover: shipping terms. So FOB, which means free on board, shipping point, and destination. If you see in the contract that it's free on board shipping point, that means that the ownership changes hands and revenues recognized when the goods leave the shipping dock. If it's free on board destination, ownership changes hands, revenue is recognized at the point of delivery to the customer, so not until it's delivered. So basically, if it's on a FedEx truck, who does it belong to? If the deal is here, it belongs to the buyer once it's on the FedEx truck. If the deal is under this term, then it belongs to the seller. So yes, this belongs to the seller when it's on the FedEx truck. So the buyer doesn't take ownership until it arrives at the point of delivery. So when AT&T fulfills its obligation to pay for the phone, Apple just records the collection of the payment, right? So in this case, AT&T paid the $3 million. So Apple writes off the account receivable, right? This is an asset. So crediting an asset, $3 million, that writes off the earlier account receivable from here. So here are some examples of ways that a company can speed up cash flows from sales. One is offer sales discounts for early payment, right? Because if you sell on account, you want the other company, the other party to pay you as quickly as possible. Charge interest after a certain time period. So kind of, this is kind of the carrot approach, and this is the stick approach. So one is, give a little bit of a discount if they pay early. One is start charging interest if it takes too long. Adopt effective credit and collection procedures, right? Are you calling the customer? Do you do a good evaluation before you sell to anybody on account? Emphasize credit card and bank card sales. So as a company, if somebody buys from you on credit card or bank card, you get that money right away. It's effectively cash because the transaction from the buyer is doing a transaction between themselves and the bank. So the bank, once they charge something on a credit card, the bank is owed money, but you get your cash right away. So here's an example of speeding up cash flow by accepting credit or debit card sales. So suppose Apple sells a computer and some other peripheral stuff for $5,000 at one of its stores. So you walk into an Apple store and you buy $5,000 worth of stuff and you pay with your Visa card, right? Visa charges Apple a 2% fee. So how does this look? We're going to ignore cost of goods. So we're just going to do the one journal entry. So how does this look for Apple for doing its accounting? Well, Apple, once you charge your Visa card, the bank is going to send Apple $4,900. Why not $5,000? Because they are charged a 2% fee, right? This $100 is just $5,000 times 2%. So they're charged this credit card discount expense. And they will show sales revenue for the full $5,000. So Apple sold $5,000 worth of stuff, but they only collected $4,900 in cash, and the other $100 went to an expense. This is a credit card fee or credit card discount expense. It can be called different things depending on the company and the textbook. So here we go again. This is just cash of $4,900, paying the $100 to the credit card fee, and then having sales revenue of $5,000. So let's look at sales returns and allowances. So, customers generally have a right to return unsatisfactory or damaged goods, right? What we do is have a credit memo. This is just a document authorizing a credit to the customer's account receivable. So this is going to, basically, we will reduce the money that a customer owes us if it's an account receivable, or give them cash back, or whatever the case may be. So let's look at an example for this to make a little bit more sense. So suppose Apple's historical experience is that 1% of the items it sells eventually are returned. Assume that Apple's sales revenue for the month of June 2018 is $200 million. To estimate its sales returns and adjust its inventory, Apple would record the following two entries June 30th. Assume that cost of goods sold is 60% of sales. Okay, so in other words, if Apple sells an item for $100, that item costs them $60, right? That was cost of goods sold, or COGS. So here's the thing in accounting. Let me take a step back. If you remember back from when we talked about chapter 1, one of the key topics in accounting is the matching principle. We generally want to match expenses in the period that the revenues are recognized, right? So as close as possible. So the reason this journal entry comes about is we don't actually know how much of the items will eventually be returned. We know historically it's around 1%. That's an estimate. So what we're going to do is we're actually going to create an account here in the journal entries for these sales returns and allowances. Kind of like, think of it like a bucket that later on, when customers actually do come back and bring stuff back, we've already accounted for it. Does that make sense? Maybe it will, maybe it won't right away, but it's an important concept because we're going to talk about that in 1 second for accounts receivable. So as you can see here, we're taking our sales of 200 million, multiplying it times 1%, which is historically how much items are returned, right? And that gives us 2 million. So what we're doing here is we're debiting an account called sales returns and allowances and crediting a liability account called sales refunds payable. And then we'll have to adjust our inventory. So we're going to have an inventory returns estimated, because again, these returns actually haven't happened. So this is like a paper inventory account, right? And then we're going to adjust our costs of goods sold for the amount, right? So what did we do here? We recorded our estimated refunds for June, and we recorded the cost of our estimated returns for June. So now let's go to July. Now we're in July. Apple customers actually return 1.8 million of inventory. So our estimate was that it would be 2 million. It turns out they return 1.8 million. So we're going to use the same cost of goods sold percentage, 60%, and we're going to make the following journal entries. So you can see now we're pulling, so this is 1.8 million, right? That's where the number came from. And you can see what we're doing is pulling this 1.8 million out of this liability, sales refunds payable. So we're decreasing this liability. And now we are giving back the customer either cash or we're reducing their account receivable, depending on how they paid originally. So now we are recording the actual refund. And for inventory, now we actually have 1,080,000 worth of inventory that came back, right? 60% times the 1.8 million of sales up here. And we're decreasing this inventory returns estimated paper account. So this is the cost of items returned in July. So let's look at sales discounts. So what are sales discounts? So businesses will offer a percentage discount if the customer agrees to pay earlier than 30 days. Again, a way to incentivize, create incentives for getting cash as quickly as possible. So here's an example of two types of sales discounts, 210 net 30. So 2/10 N/30. This just means 210 net 30. So the seller will discount the sale by 2% if the buyer pays within 2 days. That's 210. If the buyer pays within 10 days. If the buyer doesn't pay within 10 days, it still must pay the full amount within 30 days. So net amount, the whole amount within 30 days. So let's look through an example. Ace Hardware makes sales of building materials to several large construction companies. To encourage customers to pay within 10 days, Ace Hardware offers its customers a 210 net 30 discount on all sales. On June 30th, Ace sells $100,000 of lumber on account to Sorrell's construction company, and the lumber is delivered that day. The cost of the lumber to Ace is $75,000. So this is bought on account, so account receivable, $100,000, sales revenue, $100,000. Okay, that's the sale of lumber on account. Next transaction, the cost of the lumber to Ace was $75,000, so cost of goods sold, $75,000, and reducing your inventory by $75,000. Now, Sorrell's pays the invoice in full in less than 10 days. So remember, it was 210, so they got a 2% discount. So how does that work? Well, Sorrell's now will only pay $98,000 in cash. So Ace received cash of $98,000. $2,000 was a discount, a sales discount. And then we need to write off the account receivable. They paid it in full, $100,000, right? So of the $100,000, they paid us $98,000 cash, and we gave them 2% off because they paid within 10 days. So that's the transaction. record a collection on account receivable less the 2% discount. And so when all is said and done, you now see this net revenue figure. And when we look at the 10K of a company like Apple, you'll see this figure net revenue. So what is net? It's net of all these things we've talked about, sales, discounts, and allowances. So let's look at accounts receivable now. So as a reminder, what are receivables? They're monetary money claims against others. It's a current asset. We usually expect to collect it within 1 year. Very often you'll see the word trade receivables used, so they mean really the same thing. The reason you get the receivables is by selling goods and services, right? Accounts receivable. Or if you lend money to somebody, that would be a note receivable. So again, here would be the journal entry for performing a service on account, debit accounts receivable, credit service revenue. Could be product revenue too. And for lending money with a note receivable, you're going to get a note receivable when you lend and cash goes out the door. So that's loaning money to another company. And here's how it looks in a general ledger account. The key thing to remember is, we just kind of call this generic accounts receivable in the general ledger, but often there are things called subsidiary ledgers. For accounts receivable, what it means is every customer is going to kind of have their own T account, right? So these 3 customers, Brown, FedEx, and Moody's, kind of have their own subsidiary accounts receivable accounts. So we can look at them all in detail. And in total, the accounts receivable main general ledger account would have this 9,000 balance, but it's really broken up against these 3 customer accounts. Part of the challenge of doing accounts receivable as a company is that you're risking not collecting when you sell on credit, right? So if you sell to a company like Sears that's struggling, you may not ever collect on that account receivable. So some of the tools that are used by companies is running credit checks, right? Really only providing this to credit-worthy customers. Again, separation of duties, always separate cash handling and record keeping. That's just kind of a reminder on, around fraud and things like that. Keep a close eye on customers' payment habits. Are customers paying early? Are they always paying at the last minute? Are they calling you because they always need to kind of extend their payment details? What's going on? Send plenty of statements, right? And have customers sign agreements to do electronic fund transfers. Usually, if the customer doesn't have to write a check, it just comes directly out of their bank account, it's easier to collect. So let's see in accounting how we evaluate collectability using something called the allowance for uncollectible accounts. So as a reminder, the reason we do credit sales, what's the big benefit? Well, we'll usually have higher sales and potentially higher profits, right? Have you ever gone to a restaurant or a business where the only thing they take is cash, and sometimes you just don't have cash in your wallet, so you end up not buying anything there, right? So that's one reason a lot of places would rather sell on credit too. What are some of the costs? Well, again, you may not collect from some customers, right? And this gets recorded as an uncollectible account expense. So let's talk about the allowance method. Okay, this method records losses from failure to collect receivables. You base it on the company's past collection experiences. So again, this is going to be an estimate initially, right? Because we want to match revenues and expenses. So we're selling on accounts receivable, for example, in this period. We don't know how long it will take before those accounts receivable go bad. So we have to estimate a percentage that will go bad in order to kind of show that expense in this period in accounting because of the matching principle. So we're going to record an uncollectible account expense, and we're going to set up a new contra account called the allowance for uncollectible accounts. And the sister account here, right? So this is going to be a contra account, and it's tied to accounts receivable. That is kind of the sister account, if you want to call it that. This account shows the amount the business expects not to collect. So you have account receivable. The way this is going to look on your balance sheet is you'll have accounts receivable of 10,000, Then you're going to have this new contra account called allowance for uncollectible accounts. In this case, we made an allowance of 900. So on our balance sheet, on our Form 10K, we're going to show 9,100 as our accounts receivable net, right? So remember, I mentioned in the introduction, we see this word net a lot. So for accounts receivable, that's what it means. It's net of this allowance. So on the income statement, what we're going to have is we're going to have our sales revenue, and then we're going to have this expense account called uncollectible account expense, in this case 190 for the period. And again, I want to emphasize, this does not necessarily mean that we did not collect 190 this period. This just means we made an estimate that we're going to have this expense of 190. It probably won't come around until the future. So there's two ways that we can estimate our uncollectibles. One is the percent of sales method. This is also often known as the income statement approach. Okay, the reason is we calculate the expense based on a percent of revenue for a given period. The other one is called the aging of receivables method. This is called the balance sheet approach, because here we're actually going to analyze our accounts receivable based on how long they have been outstanding. So let's start with a percent of sales method. So let's look at a balance sheet before we make any adjustments for year end. Here are the balances. We have our accounts receivable, a debit balance of 15,807, and we have our allowance for uncollectible accounts, a credit of 5. Okay. So again, this is the contra account, right? Contra asset account. And these are kind of connected, because on our balance sheet, we're going to do 15,807 less 5 equals 15,802. So the percent of sales method is this. Apple's credit department estimates uncollectible account expense is 0.0002% of total revenues. And for this period, our total revenues were this amount. So what we're going to do is we're going to debit uncollectible account expense, and we're going to calculate the number by taking our sales for this period times our estimated percentage that are going to be uncollectible. And that is our expense figure. And we're going to add this 43 into the bucket called allowance for uncollectible accounts, right, into here. So we're going to add that 43. So here's how it looks now. So we have our accounts receivable, 15,807. We started with 5. This last transaction we just did on the previous slide added another 43. We now have 48. So now we're going to have net accounts receivable of 15,759. That is just this number minus 48, which is this number. And our income statement transaction, our expense was 43, and that just came from here. So let's look now at the aging of receivables method. This is a little different. We still have the same starting point, okay, that we had before. But now we're going to go and look at accounts receivable and individual accounts. And we're going to look and figure out, okay, how much of accounts do we have that are 1 to 30 days outstanding? How many that we have 31 to 60 days outstanding? How many that are 61 to 90 days? And on and on and on, okay? So we'll look at the number. In this case, we have this much in 1 to 30 days outstanding. Historically, of this amount, if they're only 1 to 30 days outstanding, about this percentage will go bad. So this should be $31 based on this bucket. The accounts that we have that are 30 to 61 days outstanding, so over 30 days now, but under 60 days, we have 600 of those outstanding, and historically, 1% will go bad. So we take $6 from this bucket, and on and on and on. And then when we add it up, we see that our bucket should be $53. When we analyze all of these buckets, we say our bucket should be a $53 estimate of how many accounts will go bad. So with this method, what we need to do is bring the balance of the allowance account that right now shows $5 to the amount that we determined using this process, which is $53. So in order to go from $5 to $53, how much do we have to credit? 48. So that's the journal entry. Our uncollectible account expense is going to be 48 using this method, and we're going to add to this allowance for uncollectible accounts 48, so that when all is said and done, we have our desired 53 that we calculated. So what does it actually look like later on when we write off an uncollectible account, right? So we look, and Apple has the following accounts: an account receivable from some customer, RS, TM, and an other, right? So we have 9 from RS, 3 from TM, all these other ones, a total of 15,807. And in the previous step, we created our allowance for uncollectible accounts. We added the 48 to get us to 53. So we have this allowance of 53. So notice our net accounts receivable is 15,754. Now, early in 2017, Apple Inc.'s credit department determines that Apple Inc. cannot collect from RS and RM. So these are bad debts. We need to write off these receivables. So first, we're going to write off the bad receivables, right? We have to get them off our books. We will never collect on this. So where is this coming from? It's not an expense. We're pulling it out of the allowance for uncollectible accounts, the 12. So here is kind of the aha moment for this. So we've written off this account receivable. We've written off this account receivable. We still have all these other ones. So our total accounts receivable is 15,795. But because we're taking this 12 out of this bucket, so we're now reducing this to 41, our allowance is decreased by 41, our net accounts receivable is exactly 15,754, which is what it was over here before we wrote these off, right? When they were still on the books. So as you can see, using this method, the actual write-off, right, the write-off of uncollectible accounts leaves our net accounts receivable the same, because we have this bucket allowance for uncollectible accounts that we pull from. This is the key takeaway from this entire section and chapter. So again, this is just a visual for comparing these two methods for estimating uncollectible accounts. The percent of sales method, right? It adjusts allowance for uncollectible accounts by the amount of the uncollectible account expense. And then you have the aging of receivables, which adjusts the allowance for uncollectible accounts to the amount of the uncollectible accounts receivable. If this visual isn't all that helpful, you're welcome to go back and look at how we did those methods again. You know, the nice thing would be just to directly write off, do the direct write-off method, right? So wait until a customer actually proves to be uncollectible and then do it. Unfortunately, this is not going to conform with generally accepted accounting principles, so it's not allowed. You must use the method of creating this allowance. Why? Because then you have no allowance for an uncollectible, and you may be overstating the assets that you have on the balance sheet. You might be showing accounts receivable of 1,000, but the reality is, 200 of them might never pay, so your net accounts receivable should really be 800, right? So as an outsider, you might not be showing it accurately. If you're showing 1,000, you should be showing 800. So this direct write-off method is not allowed. And this is how it would work if it were to be allowed, right? You would just do uncollectible account expense at the time when the accounts went bad, right? So this is writing off by the direct write-off method. Again, not allowed. GAAP doesn't allow. Here's one other, we've been doing this throughout the book now and kind of throughout the class, doing some of the analysis in the T accounts, in the general ledger accounts. And this is computing cash collections from customers. If you look at the T account for account receivable, you generally have a beginning balance in there, right? We can see how much sales we have on account, so we can add that in. So that means our ending balance should be 2,000, right? But it's not, it's only 400. So because it's only 400, we can look here and we see that we have a write-off of collectibles of 100, And then the remaining balance must be amounts that we collected from customers. So we don't have 2,000, we have 400. Why? Because this 1,600 here came from $100 worth of writing off uncollectibles and 1,500 collecting from customers. So if we know everything, we can solve for X. Let's look at accounting for notes receivable and interest revenue. A few terminology things. So creditor, this is the person you owe the money to, also known as the lender, the one who's lending you the money. Debtor is the person that borrowed the money and owes the money. This might also be known as the maker or the borrower. Interest is the cost of borrowing money. This is stated, this is very important. As a business convention, interest is stated as an annual percentage rate. So if you hear a 6-month note at 7%, this is a annual 12-month rate. So if you want to calculate the interest, you have to limit it by the 6 months that the note is outstanding. The maturity date is the date at which the debtor must pay the note. The maturity value is just the principal plus the interest. So most notes receivable, you just make one payment at the end. You pay back the principal and you pay back all the interest. And that's what's known as the maturity value. The principal, the amount of money that was borrowed, and the term is the length of time when the note was signed to when the payment must be made. And this is just a visual of a promissory note. Rarely do these things exist in paper anymore. Most of the time they're done through a computer system of some sort, right? But you can kind of look at all the parts here, you know, when the date it starts, the principal amount, the maturity date, you know, the maker, whoever took out the loan, they're going to sign for it. You'll see annual interest rate of 9% and the principal amount 1,000. So let's focus on the accounting for this. So consider the promissory note back here. This is Exhibit 5.4. After Lauren Holland signs the note, Continental Bank gives her 1,000 cash. The bank is going to make the following entry for this loan, right? They gave her 1,000 cash, so cash goes down by 1,000, it's credited, and they now have a note receivable of 1,000, so we have note receivable that's debited. Now the bank, again, this is the bank that's doing the accounting, will accrue, back from Chapter 3, you're going to accrue the 9% interest rate for 4 months when you're closing the books. So in this situation, they are doing adjusting journal entries as of December 31st, 2018. They're debiting interest receivable, and the calculation here is the $1,000 principal times the 9% annual interest rate times the period of time that it was outstanding, 4 out of 12 months. So they're going to accrue $30 of interest that they are due, and they're going to show interest revenue of $30. No interest has been paid yet, but you are accruing what you're already owed, right? So you have an interest receivable and interest revenue. And on your balance sheet, on the bank's balance sheet at the end of the period, they're going to show this note receivable plus this $30 of interest they've already earned. And on the income statement, they will have that $30 of interest revenue. Then on February 28, 2019, the note is collected. So the borrower pays the bank back the principal, $1,000, plus the interest, which calculated out to be $45. How was it $45? Well, this loan was $1,000 times 9%, and it lasted for 6 months out of 12. So that interest is $45. And then they're going to write off the note receivable, so credit 1,000, write off the interest receivable, credit 30, because now it's going to be paid in cash, and show the final $15 of interest revenue. You closed the books December 31st. Now we're 2 months later, February 28th, so you're calculating $1,000 times 9% times the 2 months, January and February. So you can see this note receivable from L. Holland, you had a debit of 1,000, you credit it for 1,000, we've written it off. The person paid us back. Again, interest, a lot of people get stuck on calculating interest. So rates are usually expressed as an annual percent. So you must use the fraction for time periods that are less than a year. right? If it's monthly, you can calculate it like this. If it's days, then this is one convention. There are a number of conventions of calculating interest, so this is pretty important. Finally, let's quickly look at some liquidity ratios. So we're going to introduce some new ratios. So first is the quick or acid test ratio. This is basically a derivative of our current ratio. If you remember, the current ratio was current assets over current liabilities. Well, the quick or acid test ratio basically changes this numerator, current assets, to look at just the most liquid assets possible, basically cash, short-term investments, and net current receivables. Because those three things are converted, you can convert to cash very, very quickly, usually in a matter of days, right? So a higher ratio here indicates easier to pay current liabilities. And what's considered acceptable is just going to depend on the industry. So in the case of Apple, if we do the analysis and we look at Apple's 10K and look at their cash, short-term investments, and net current receivables, you'll see we get these numbers. This is their current liabilities. So we get a quick or acid test ratio of 1.05. So Apple has $1.05 in quick assets for every $1 of current liabilities. Another thing we'll talk about is a turnover ratio. There's a number of these that we're going to talk about throughout this class. This is the accounts receivable turnover. And basically what we do is do net credit sales, so the net credit sales for a time period, and then the average net accounts receivable during that time period. So this is just to do the average of any figure in accounting, like accounts receivable. You're just doing the beginning plus ending dividing by 2. Okay, so that's how you get that. If you do the math here, you'll get this turnover of 13.23 times. So think of it like you, on average, you collected 13.23 times of your average account receivable into your sales, right? The turnover ratio is very kind of difficult to intuitively understand. So what we do is we create what's called a days sales outstanding. We simply take 365, the amount of days in a year, and divide it by this turnover ratio, and you'll get 27.6 days. And this is a little bit more intuitive. Think of the 27.6 days like, on average, it took you 27.6 days to collect your account receivable, right? So that makes a little bit more intuitive sense. And there's another way you can calculate this. So one is this is a multi-step process here. You do a average daily sales calculation, just your net credit sales divided by 365 days. So for Apple, we took the net credit sales divided by 365 and got $590.79 per day. Okay. Then you can do days sales in receivables. So this 590.79 that we calculated in step 1, we're going to put here in the denominator, right? And the average net receivables is, again, just your beginning net receivables plus your ending net receivables divided by 2. So here you go, this plus this divided by 2 equals 16,301.50. So if you put those numbers into here, you get the 27.6 days. So this is another way to calculate it, but you can just do an account receivable turnover first, plug that into the days sales outstanding equation, and you'll get the same 27.6 days. So whatever you prefer. So anyway,